This is Chapter 7 homework. Now, I'm not going to give you the answers, but I am going to guide you through it, and I have cleaned this up a little bit, so it looks a little bit different than the one that was on the site. So, here we go. This one's talking about percent of receivables, and the main point here is to see the difference between how we calculate bad debts. Now remember, I'm using the entire accounts receivable, so that means that what I actually calculate here, okay, is going to be the balance that I want in the allowance account. So let's just get started, and maybe that'll get better. This one talks about you're going to take the entire estimate the balance of the allowance assuming the company uses 6% of total accounts receivable to estimate the uncollectibles instead of using an aging method. Okay, so your total is 660. So 660 will go here. You'll multiply it times 6%, and that will give you the allowance balance. So, and that check figure is $39.60. Now, if we do it the aging method, where we're going to take each one of these due dates, past due, and multiply it by a percent to find out what's going to be uncollectible, then you're going to have a different number. So all you'll have to do is take this 414, I'll show you, and put in 1% here. And this is going to automatically calculate for you. Not going to make you do calculations. The whole idea for this in particular is for you to understand the concept of how this all works. So that gets you set up, okay? That gets you set up to do the calculations here. Now, I don't care which set you use. You can use 3960 for your balance, 600 for your balance, or 16320 for your balance. What I would like for you to do is say, okay, I'm using, let's say, B. This is going to be my bad debts calculation. So, in each case, this becomes what the balance is going to be for your allowance account. So whatever you have to adjust this for becomes your bad debts expense. If I had a $13,800 credit balance and I need a $16,320 credit balance, what do I have to do? Well, it looks like I would have to credit the allowance for so much, and then the debit becomes my bad debt expense. Do the same thing for the other scenario where you have a debit balance. Okay, I've got a debit balance. I need a credit balance of $16,320. What do I have to do? What kind of entry do I have to make in the credit side here to create a balance of $16,320. That's all this problem is about. So I hope that helps. Email with questions. The next one is really, really simple. I just want you to recognize different ways that the allowance account can be estimated. First of all, they could just use credit sales. So you'll multiply using that $315,000. The next way they could do is say all sales and use a percentage of that. And then the final way would be to use the year-end accounts receivable, which is right here. These are your percentages to use, and then you're going to look at this as if your allowance was 6,500 debit. So I guess we need to maybe show you that. So this is the allowance account, and it has a debit balance of $6,500. Now, what kind of entry do you have to make to create the balance that you want? Now you have to remember, credit sales is different than year-end accounts receivable. Credit sales is just looking at the period. So that bad debts, okay, is not going to be the allowance balance here. It's going to be the actual bad debts expense. So that would be the actual expense. Now, for total sales, again, we're just looking at the year. So that's actually going to be the actual, if you can spell, expense. But now this one is the kicker. I have a year-end accounts receivable, okay? That means I also have prior year's accounts receivable in here. So this calculation is going to be for getting the allowance balance. Now what do I mean by that? Well, you have to spell it right first. So this one is going to look at year-end. So what is year-end? So I'm going to take 9% of this $140,000. And what this is going to give me is what the allowance balance should be. The allowance balance here should be $12,600, sorry. So now, what does it take? This entry here has to create that balance. So I have a debit here. I need to credit the allowance account to make it equal $12,600. These two are the actual expense, so whatever you calculate out is what will be credited and debited to the expense. This one is dealing with prior year charges that have already been considered in the accumulation. So when you calculate this out and you get this $1260, you end up with this being the balance, and your bad debts expense is going to be the adjustment to that account. Give that a whirl. And then the very last one can be somewhat confusing. I've given you a bunch of support things here for the interest. So what you need to do is calculate all of these first. So Lee has a note for $20,000. Its rate is 6%, and it's for 45 days. So you're going to take this and do the overall interest first. So that's $20,000 times 6% times the 45 divided by 360. This will give you the total interest. Now, there's a thing up here, a scenario that says at the end of the year, we need to calculate how much interest is owed for this note, and that happens to be for 18 days. So that's 20,000 times 6 times 18 divided by 360. That is going to give you that accrued revenue. And just for the heck of it, we're going to take and go ahead and calculate out the other part of that. So you take 20,000 times 6% times 27 divided by 360. You're going to use these numbers, so make sure you calculate those. Then, Thomas is going to borrow $14,000 at 8% for 90 days. You're going to do the same thing here. Figure out that interest. You do the same thing for Sheng. So now you have all your supporting data you need. Now, you can go to the scenarios here. So on December 13th, Lee decided they couldn't pay their accounts receivable and wanted to turn it into a note. So you're just going to transfer from accounts receivable to notes receivable the amount of $20,000. Now this is at the end of the year. This was on December 13th, and now it's December 31st. I need to recognize the interest earned, or interest revenue, that is coming from that note, whether it's been paid or not. And that's what this calculation right here is going to be. Whatever this number is going to be a revenue, and it's going to be an interest receivable because I haven't received it yet. On the 27th then, I receive the payment for the principal and the interest. And this is where we really haven't talked about it, but we have to a certain extent. This is the complex one. What's going to happen here? First of all, how much money is she going to pay me? Well, how much is the maturity? This should be $150. So I'm going to receive cash of $20,150. What is that comprised of? Okay, so my note receivable was for $20. That goes here. Now, I've already recognized some of the revenue, right? And I have a receivable here. So this revenue has been recognized. So I need to get rid of the receivable because they're paying it. So that's a credit for that amount. Down here, sorry. And then what is the actual revenue that I'm recognizing from January 1 to January 27th? And that would be this number here. These three right here should add up to $20,150. So this accounts receivable comes from here. This interest revenue comes from here. The note receivable is the principal amount of $20,000. And that should get you going on that. And then you have another one where you're just transferring it over. Another one, March 17th, same thing. You're taking it from here, putting it into notes receivable. Mr. Sheng decides he's not going to be able to pay the note, so now what do you do? Well, I guess kind of not complicated, but it's just some procedural things. First of all, you have to take it out in notes receivable. The interest you would have earned, you have to recognize. And you need to put that full amount into accounts receivable. Then, because this gentleman's not going to be able to pay you at all, you're going to take it out of accounts receivable, this full amount, and take it out of the allowance for doubtful debt. That will take that amount and create a bad debts. It becomes folded into the accounts receivable. So that one's kind of complex. Kind of call me or email me if you need help on that. And then the very last one is you receive payment from Thomas right here. And that's going to be your cash. And then you have to figure out the notes receivable and the interest revenue, which you have figured up right here. So we may have to go over this in class a little bit. Okay, so that is Chapter 7 homework. Next up is Chapter 8.